Pari joins us, equity manager with Axis Mutual Funds. Anupam, good to have you on Nitina. Thank you for joining us. What is keeping this market perhaps jammed? The India story is strong. Valuations are no longer stretched. Flows are strong, but India is underperforming massively.
Yeah, hi, thank you for inviting us here. See, there is too much of negative or let's say negative surprises for investor to digest, I guess. Starting last year when war broke out and then rapid interest rate hikes and then the whole banking turmoil that happened in Europe and US, and we are still hearing the news. And one should also keep in mind that from third quarter onwards, there were chatter of moderate growth in India, no growth moderation, and that's a very very important factor that we have to keep in mind. And then the whole talk started about the bulging BOP problem. Of course, now we are seeing that the problem is not as great as it was envisaged to be. But considering all this, basically it created a lot of negativity around market, around investment for the investors, and they were not able to digest and make a comprehensive picture out of it when so many things are happening around it. So that's the reason I guess that's happening. Maybe it may take further 3 to 6 months when things become more clearer, uncertainty is reduced, and then it will shape up in a good manner.
What will take us out from this, the so-called range? Will it be earnings? Will it be something on inflation? What will change, sir? अच्छे दिन कब आएंगे? 1.5 साल से वही निफ्टी.
Happens, but before 1.5 साल, that 2 साल थोड़ा बहुत पैसा भी बढ़ा था. So we have to keep that in mind also. So, things return to normal. You will always revert to mean that's the norm of the market overall. See, let's look at variables. What caused the problem? And one by one, as you get further clarity about that, I think we will get out of this rut. So first is what is happening to US in terms of interest rates. And being an emerging market, it is a very, very important factor for us. So that's I think the critical variable that we have to watch, and there has to be some clarity that whether rates have peaked out or not. And the problem is that all previous expectation that it has pivoted has gone wrong. So the US economy, especially the wage inflation, has remained much beyond expectation of any commentator. So that's a very important factor that we have to watch. The second would be how earning trajectory pans out in next 1 or 2 quarters. Because growth has moderated, and I think given the way BOP problem was being played out, everybody kind of wanted that, okay, let the growth taper out a bit. It's not a problem. So I think that would be another variable. And then, every bear market or every negativity around market creates its own trajectory of positivity. So as you said, once valuation starts looking attractive enough, automatically market will start doing well, even if, the earning trajectory is slightly far ahead. So I will not say there is too much to worry. It's a grinding market, yes, but that's the price that you have to pay in the market to make money out of it.
Anupam, last year was all about banking stocks and auto stocks, which massively outperformed. This year, they haven't had a great start. Is this a year where there's going to be again a lot of sector churn and the underperformers will come out as outperformers?
Yes, if economy improves, yes, banking as a sector will do well because valuations are very, very reasonable. And of course, there are concerns about whether NIMs at such high level will sustain or not. But if growth is there, I think still earning growth would be there. Balance sheets are very, very strong. So I'm sure that the whole underperformance that has been there for the last 2 3 months will go away. Banks will start performing again.
Okay, on that note, we'll step into a very short break with the news that the market is easily sustaining that up move. 17,070 is where we are at the index level. Just a bit of a worry on the broader market, but we'll track that for you when we come back. Don't go anywhere. Welcome back. 200 points higher when it comes to the bank nifty as well. So definite pick up there as well as Sensex up a good 400 points. The sectors continue to be pharma, FMCG, which continue to lead the rally, and metals are definitely shining in the trading session as well. Talking about metals, Vedanta has been one stock which has been fairly volatile of late, has been in the news of late on the back of several updates on its debt as well as repayment. While promoter and chairman Anil Agarwal hopes to make the group a zero debt company, note that it has almost 2 billion worth of bonds to be settled in 2024 alone. What's the road ahead for the company and how do they plan to manage the debt picture better? Let's go across to my colleague Anurag Joshi.
Yeah, so mining to oil conglomerate Vedanta needs to repay nearly half of its over $2 billion of bond and loan obligations by the end of May. So the conglomerate needs to pay a little over $2 billion of bonds and loans this year. And significantly, in April, there is a 400 million US dollar bond obligation coming up for repayment, following which on May 31, there's another 500 million bond obligation. Another key payment for the company would be early 2024, in Jan 2024, when it has to pay back $1 billion of bonds, and this is the bond for which the company had tapped many credit funds and had raised this money at a rather high coupon rate of 13, almost 14%. uh, Now, if we look at the debt maturities for this year, it's about over 2 billion, and in the coming year, this is going to be more than for about $2.6 billion for Vedanta. Now, in recently, the company has tapped and has started talking to lenders and investors for raising money for refinancing. Though the progress of these stocks are still not, it's still early and it's still uncertain. In fact, the Economic Times earlier this month had reported that one of the units of Vedanta Limited, which is THL Zinc Ventures, that has been talking to lenders for $1 billion loan facility, and is even looking to raise this money from credit funds. Media reports recently had quoted Anil Agarwal as saying that he wants to make the group a zero debt company, and has been talking to foreign lenders, notably JP Morgan, for that $1 billion of funding at around 8 to 10% interest rate.
That's the take coming in on Vedanta. Thank you so much, Anurag, for bringing that into the perspective as well. But let's look at some of the stocks which are bouncing around. And Reliance definitely deserves mention. 2.25% higher. You also have Grasim, which is the top gainer at the index, ever 3% gain coming in there. Though it's autos which are on the back foot. So Tata Motors is down 1%. M&M, of course, on account of that downgrade coming in, is down about 0.6% as well. But one space which is doing quite well is the entire healthcare segment. So Anupam, your take as far as pharma is concerned, would you be looking at buying into some of these counters? And if yes, which space? Is it going to be hospitals? Is it going to be diagnostics? Is it going to be your generic pharma makers? Which space are you inclining towards?
See, currently we are pretty bullish on hospital space because there we see more possibility, or let's say high probability of consistency in earnings. It's one of the very good unorganized to organized story in India, with per capita income going up, insurance penetration going up, the affordability is going up, and that gives us a lot of confidence on the hospital story per se. And on the other side, if you look at generic, etc., I think competition is increasing a lot, even in India now. Earlier, the high competitive intensity was in US, and hence ROEs were under pressure. So that may continue, and hence material re-rating may not be possible for these companies. So preferable bet for us is hospitals as of now. Of course, we will evaluate as and when situation comes that valuations are attractive enough. But domestic focused would be a better choice in our opinion.
Hospitals. Well, some of these hospital stocks have really hit out of the park. A, COVID, B, healthcare, C, more healthcare insurance, and then perhaps a real tilt post-COVID in terms of quality healthcare. Anupam, you know, everybody's bullish on hospitals because everybody's buying more healthcare. But if I look at the insurance companies, especially the non-life insurance companies, they are not growing. It's quite ironical, right? The thesis is Indians will buy more insurance and healthcare as a sector will grow because you want better healthcare. But the insurance sector per se is just going through an extraordinary struggle. That's life or non-life.
See, market is a very complex system. Any economy is a complex system, so you cannot, always create A plus B is equal to C kind of equation. To give you a perspective, in last 20 years, maybe infrastructure sector has seen the highest revenue per se. But there are not many companies who created huge amount of wealth for investors. So if sector is doing well and there is demand, there is revenue potential, the revenue pool is high, it doesn't mean that companies will create investor wealth. There might be competitive impact, there might be pricing pressure, etc., etc. Revenue may still be growing. So that's the reason. The difference in, let's say, pure insurance or a hospital is that the operating leverage for a hospital is very high, the pricing power is very high, and hence sustainability or profitability is good. Secondly, India is moving in healthcare from, let's say, semi-organized to fully organized space, and that's a better reason for us to be positive on hospitals because the availability of talent for smaller hospitals, maybe you have seen in smaller cities, 15, 20, 50 bed hospitals, they are not able to afford good talent, they are not able to afford provide a holistic 360-degree healthcare, etc. And the government sector is struggling in that in terms of providing good healthcare, and people want to have good quality healthcare. So, and we are also aging. We should not forget that we are aging, and that's one more reason that you need more critical quality healthcare. So that is a better, in my opinion, that is a more compelling reason for us to be in hospitals rather than anything else.
Narayana Healthcare, Krishna Institute of Medical Sciences are some of the stocks in your portfolio, at least the small cap portfolio as such. But Anupam, in your this small cap growth portfolio, you also have a lot of chemical names, Galaxy Surfactants, Fine Organic, a lot of other names as well. What makes you bullish on these counters, and what's the rationale for selecting some of these?
So chemical is a very, very big space globally, right? And even in India, it is one of the oldest sectors. You can count some of the chemical companies are 50, 60, 70-year old operating in India. Some of the companies that we own are actually more than 30-year old. They started 30, 35 year back, and then they have grown. What we look and in this sector is that companies should have some kind of niche or some kind of good capability that gives them a differentiation. We are not essentially looking for something like China plus one, etc., etc. We are not sure whether that would be a very scalable proposition or not. How long, how profitably we would be able to compete with Chinese companies. It's still unclear. Of course, there would be revenue, there would be potential, there would be opportunity. But what we look for is that can these companies, is there any company which can grow on its own merit, on its own capability, and it should have a global competitiveness, not just locally. So the companies that we own, most of them are globally competitive. They supply not just in India, but they have a decent market share outside India. And given their spend on R&D, given their product development history and their cost advantage, they have a very good potential for further market share gain globally. And that gives us confidence. That is how we evaluate and own the companies in this space.
Let you go on that note. Thank you so much for joining us and talking to us about the top sector bets that you have at this point of time. But Shivangi wanted to come back to you.